We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Alfonso Peccatiello, author of the Macro Compass Substack, now the biggest finance newsletter on Substack, and it's also free. How are you today, Alf?
Hey, Tom. I'm good, and I'm very happy to be back on the channel.
It's always great to have you, and you know it's great to be able to have somebody that's such a good communicator about all of these these topics that can be very intimidating. So I appreciate getting your time and your perspective on all these things, Alf.
Well, it's a pleasure. Let's see if we can communicate well what the heck is going on, because there is so much going on out there.
Absolutely. So, Alf, you know, we typically hear that the bond market is the smartest and one of the most important markets in the world, and that many traders take cues from it. But you recently wrote an article about the repo market, saying that it could instead be the most important market. So why is this? So
think about the bond market as the bottom of the pyramid. So the pyramid would be all the asset classes and the more layer of financialization that we added to our economy over time. So in the 80s, we only had bonds and equities and maybe a few more instruments, and that was it. And then in the 90s, in the 2000s, we started to add securitization, and the credit market became more complex, and then retail came into play, and then now retail start playing options like there is no tomorrow, right? So we keep adding levels of complexity over the system. Bonds are the bottom of the pyramid. They are the most risk-free, especially government bonds. The closest thing to a risk-free instrument, very liquid instrument, very tradable, right? And it's pretty stable as well when it comes to price. The repo market, Tom, it underlies the very bottom of the pyramid. So the repo market is the market that allows buyers and sellers actually in the bond market to be able to borrow and lend securities in exchange for cash. And now you have to imagine that because we managed to lever up our financial system to make it very complex, behind most of the transactions that involve treasuries or government bonds, there is always somebody who's borrowing them to add up leverage. So imagine a hedge fund. A hedge fund is a typical player in this market. A hedge fund thinks that there is a small distortion in some market, in the bond market. They maybe think that bond is slightly more expensive than the other one. But what they will do is they will borrow the bond that they want to sell. They will then sell it, and they will buy the other bond against the bond they just sold using the repo market. The repo allows them to borrow a security they don't have and then to sell it up to the market to try and buy it later. So repo allows an enormous amount of leverage on the bottom of the pyramid, which is the treasury market. And the reason why that happens is because being a very stable market, a lot of players feel that they can lever up. Because once the underlying is very stable, you can add leverage and not much happens. You can actually only magnify returns, keeping volatility low. That's what most people tend to think. And that's why when the repo market blows up, a lot happens, because you're shaking not only the foundations, you're shaking the foundation of the foundation, which allows a lot of leverage to be put on the bottom of the pyramid.
Mm-hmm. So, Alf, how big is the repo market, and does it trade with a lot of frequency?
Yes, it trades very, very frequently. And the estimate is I think in the low digit trillions per day. So we're talking 3 to 4 trillion, top of my head, for government bond repo markets all over the world. I'm talking about liquid stuff. So euro, dollar, Japanese yen, government bonds. Mm-hmm. It trades very frequently. I used to repo out the bonds that I was buying when I was managing the portfolio for the bank every single day. So what you do is use that as a source of financing. You have a certain portfolio. You say to somebody, here is my collateral. Here is my good quality bond. Lend me some cash, please. And then you'll take the cash and you'll do something else with it. You'll arrange another operation. But Tom, there will be somebody on the other side of the equation. That's what people often forget about the bond market. It's not only about, let's say, the borrower of cash, but it's also the guy who's lending the cash. So what is the interest that he has in lending the cash and borrowing the security against it? So somebody who has cash, why would he want to lend that cash away and get the security against it? So who's on the other side of the equation is, for instance, pension funds or asset manager or corporate treasurers. People don't think about it, but these guys, Tom, when they have cash on their balance sheet, what do they really have? What they have is a bank deposit. Imagine Apple. Apple has a lot of cash on the balance sheet. What is that cash? That cash is a bank deposit at Wells Fargo. It's a bank deposit at JP Morgan. Guys, that's unsecured money. If Wells Fargo or JP Morgan has some issues tomorrow, Apple is at risk of losing their cash. So you can imagine that they want to diversify how they own this short-term cash. So what they do is, hey, Alf, I'm the corporate treasurer of Apple. I have some cash. Do you want it? Yeah, sure. Please lend it to me. Yes, but I want something that collateralizes this loan, that makes it pretty safe. And that is a treasury. So if I have a treasury, I have to post it as collateral, and that's exactly the other side of the repo market. So you are now making, basically putting in communication a corporate treasurer who has excess cash and wants good collateral against it, and me, who I'm a bank portfolio manager who has a lot of bonds and wants to finance some of these operations. So you can now understand how many intricacies and complexities there are in the repo market. It allows to communicate a lot of different players in the most liquid market in the world, which is government bonds.
Mm-hmm. So, Alf, when does the repo market start to signal risk in the equity markets or in the corporate bond markets?
Yeah. So imagine, Tom, that a hedge fund trader or a bank portfolio manager is using repo to finance, to lever up his balance sheet, right? As long as the financing costs remain very low and predictably low, he will be able to manage this leverage without many problems. It's a little bit like having a variable rate mortgage. And as long as the benchmark rate remains very low and predictable, you are comfortable with the leverage you took, right, to buy the house. The moment those repo rates start to go up, that's when a lot of issues can happen, because refinancing all this leverage you added becomes more expensive. Now, when do repo markets actually tend to move? Now, when there is some imbalance is the answer. So the repo market works as a balance mechanism between people who have a lot of cash or cash equivalent instrument and people who have bonds or good collateral to lend against it. When the system is asked to take a lot of bonds on it, while maybe liquidity is getting withdrawn at the same time, the risk that the repo market has some issues increases, because there is little liquidity that can or wants to be exchanged for a large amount of collateral. The same happens when the collateral is very, very scarce and there is abundant liquidity. So imagine now today that the reverse repo facility has over $2 trillion sitting in it, Tom. That's a lot of cash that money market funds can't do anything with it and then just park it back at the Fed. Now, there is a lot of this excess short-term cash, and the availability of short-term good treasury bonds is pretty limited right now because the government isn't issuing a lot. They don't want to spend money in the real economy. They want to cool inflation down. They're not issuing. So all this cash tries to chase this very scarce amount of collateral, and that's why repo market can be very tight right now. But now think of quantitative tightening. What quantitative tightening will do is it will ask the financial sector to take on more bonds because the Fed won't be buying them anymore. And at the same time, will shrink the balance sheet of the Fed, which also shrinks the reserves in the system. So there will be less interbank liquidity, less reserves, more collateral to be absorbed. And so the repo market can rebalance on the way up. When this rebalancing between demand and supply of collateral and cash becomes too acute, the repo market tends to move very fast. And when it moves very fast, to answer your question on the equity market, when it moves very fast, remember the pyramid story. The bottom of the pyramid starts to shake. And when the bottom of the pyramid shakes, imagine what happens to the second, the third, the fourth layer, the credit market, the, let's say, mezzanine market, the equity market. All of that starts to become even more shaky because the foundations are moving and people allocating capital are saying, whoa. If the treasuries are becoming volatile, if the repo market isn't stable anymore, I am going to pull out my financing and my capital from the most risky part of the pyramid, and I'm going to back up my risk tolerance.
Mm-hmm. So, exactly in that example or in that vein, Alf, if we take the example of the fall of 2019 stress episode, what happened in that case?
Yeah. So what happened in that case is that if you remember, the Federal Reserve tried and actually was doing quantitative tightening in a decent size. They started in 2018 and they were proceeding by doing it throughout 2018 and 2019. When you do quantitative tightening and at the same time you go in and you want to issue a lot of bonds to finance tax spending bills that were basically made up by the Trump administration in 2017 and 2018, what you are doing is, Tom, you are issuing a lot of bonds to finance this tax, basically this expenditure, government expenditure, tax cuts, right? That were the legacy of the Trump administration. You're issuing a lot of bonds, and you're then saying to the sector, I'm going to take away liquidity. I'm doing quantitative tightening. I'm not buying those bonds anymore. And on top of it, I'm taking reserves away from you guys. Now, what happens is that you are reducing the amount of interbank liquidity. Those are reserves that can be used in repo transactions. And you're saying to the private sector, I'm taking liquidity away and I'm adding bonds. So both at the same time. And as you keep doing this for a while, until you reach a level where people are not very keen anymore in exchanging this cash for collateral very aggressively, the repo market starts to adjust. Because this imbalance is now moving all the way. There is way too much collateral out there, and there are not so many reserves anymore. So you have to understand the marginal price, which is the repo rate, at which collateral gets exchanged for reserves, changes very quickly. And when that happens very quickly and you reach breaking points, at some point, people just don't engage in repo transactions anymore. So people who were leveraged before, they need repo. They need to refinance their activities every day, Tom. And when one side of the equation is saying, sorry, but I'm not going to do that anymore, then the repo market can explode. And one of the characteristics of the repo market is that it is non-linear. It can explode higher and it can become very tight very quickly. It's a convex reaction rather than linear adjustment because leverage allows for that convexity. Once there is a lot of leverage in, either things are very calm because leverage enforces people always get into the same trade, they crowd it, there is leverage that crowds it, and then at some point it explodes in a nonlinear fashion. That's why the Federal Reserve also set up this standard repo facility that is basically right now you can say backstop against this convexity behavior of the repo market, because you can effectively always get your repo transaction at the Federal Reserve at a higher price than normal, but it's a backstop facility that would sort of fight hard against these convex reactions.
So when we think about the effects that the Fed has really had on the market since it started raising rates and doing this quantitative tightening that we mentioned, or even speaking about doing such things, when we get, for example, a seemingly positive jobs number come out and we get a market rally, if the Fed has changed nothing else, should these be considered bear trap rallies when the overall trend is lower for the markets until the Fed, materially changes its posture?
Yes, that would be the very short answer to your question, but let's elaborate a second. It was a good question, Tom. I actually tackled it in one article of the Macro Compass, which was called, is it a bear market rally or is it a turning point in the stock market? And back then I argued in the article that it was a bear market rally. And there were many reasons why it was one. So first of all, bear market rallies are historically very tough psychologically speaking, because they can be vicious. They can be all the way 20 to 30% rally from the lows that make bears doubt whether their view still stands correct, and they make bull believe there is a new bull market coming. So it's a very testing psychological pattern to have a very large bear market rally. Now, the reason why the recent one happened is a bunch of reasons. The first is in July, people understood that Powell had pivoted. He came to the press and he said to the FOMC press conference, and he said that the Fed is going to slow down the pace of hiking, that we reached neutral, and from neutral onwards, they need to be more careful with the pace of hiking. They can just not keep blindly hiking 75 basis points because now we start to be restricted. So you got to be careful. Effectively was saying that no 75 basis point hike anymore, just blindly. They're going to be data dependent, but they're going to do maybe a bunch of 50 basis point hikes, and they're going to be a bit more careful with the way they proceed. The market understood that they were done or almost done. The market understood that they would basically hike until 3.5%, and then they would stop there. Maybe they would even cut rates. They would be very data dependent. And this data dependency, Tom, was important for markets because the bond market has such a strong opinion that inflation will come down very, very quickly. I put a chart in the Macro Compass that shows that traders are expecting inflation between summer 23 and summer 24 to average around 2.5% to 3%. Guys, we're almost at 9 right now. To reach those levels, it means that month-on-month inflation needs to be basically 0%, like the last point we had, but for a sustained amount of time, for 12 to 16 months, until you can get to levels that are consistent with this prediction from the bond market. But when Powell says we're going to be data dependent, we are not going to be rigid anymore, and the bond market has already this very strong opinion inflation is going to come down, they can adjust everything else. They can adjust equity pricing, Bitcoin pricing, gold, anything, to the very belief that inflation is going to slow down, and therefore the Fed is going to adjust their policy. Mm-hmm. Okay, so that's all it started. And then there was a second leg of the rally. The second leg of the rally was driven by what I call macro insensitive buyers. There are a lot of actors out there, volatility target funds, trend following strategies. All these guys, Tom, were basically forced out of the market in the first half of the year. And why? Because volatility was increasing everywhere. Bond market volatility higher, equity market higher, FX higher, everything higher. And when you're a fund that is targeting a certain amount of volatility and volatility is increasing, well, you can understand you've got to shrink your allocation. Otherwise, you cannot meet your volatility target. You have to be more conservative. When volatility is low, you can lever up. Same if you're a trend following. Hey, if the trend is coming down, you cannot be long anymore because it keeps going down. What happened after this, I think, mistaken market reading of the Powell conference is that volatility came down because everybody thought that the Fed is going to, be more relaxed. As volatility came down, all these buyers that were pushed out of the market could come back in, Tom, and they come in with a vengeance. They lever up and they start buying again everything, including meme stocks, including the most cyclical retail stuff, broke stocks, actually literally broke companies, rallied 50% on a week. What that tells you is that it was just an indiscriminate buying activity of everything that smelled like risk because people were so underexposed at that point. Mm-hmm. I do not think this rally is sustainable. And the very simple reason why I don't think so is that, first of all, it is very debatable that we're going to be seeing an inflation slowdown that is as strong that would allow the Federal Reserve to back off. And second, and linked to that, is that the Federal Reserve inflation target has not changed, Tom. And I want your audience to understand this, or at least my point of view. I hear a lot that the Federal Reserve is going to be happy with 4% inflation. Inflation is going to slow down from 9 to 3 and 4, and they're going to be happy with it. No, they are not going to be happy. No central bank can be happy with an inflation which is double their mandate because it's a complete loss of credibility. And it's a risk that inflation expectations get anchored higher and that people understand this is a new regime and they go and ask for much higher salaries, Tom. And that starts that vicious or virtuous circle, whatever you want to call it, depending from the point of view, that scares central bankers because once they lose control on inflation expectations and people demand higher salaries and they have higher purchasing power, it's a very hard machine to stop. They cannot compromise on that.
Mm-hmm. Alf, I want to get to a little bit more of the inflation stuff, but before we do, we've mentioned quantitative tightening a couple times here, and the Fed has seemingly been behind schedule on this balance sheet runoff. So is this because they are, outright lying about it, or is there more to understand here?
No, they're not lying about it, Tom. And I am not a fan of central bankers in general. I want to state that clear. I think there's a lot of mistakes that they do, and they're not held accountable for it, but they are not lying on quantitative tightening, coming to their defense now. So what's happening is that people are seeing the balance sheet of the Fed shrink, but not as fast as the Federal Reserve promised it would, right? That's the problem. And they're saying, well, they're lying. They're reinvesting more that they promised they would. Well, you have to understand two things, Tom. The first is the Federal Reserve balance sheet is composed of Treasury securities, Treasury inflation protected securities, and the mortgage-backed securities. Those are the three main assets the Fed has bought in QE, right? So when they need to shrink the balance sheet, they're not selling right now. They told us very clearly, we're not going to sell bonds. We're going to wait for bonds to mature, and then we're not going to buy them all over again. And that's the way we shrink the balance sheet. Okay, it's a passive quantitative tightening. When a nominal treasury matures, it's very simple to understand. It matures, and then the cash comes in, the Fed doesn't buy it anymore. These maturities are well set. They're generally 15th and 30th of the month. So even then, you've got to be careful which day of the month you look at the balance sheet, because between the 1st and the 15th of the month, and between the 15th and the 30th of the month, there is not much happening in maturities terms. So mechanically, you have to wait for half the month, end of the month. That's the first layer, easy to understand. Sometimes, though, it causes some distortion because people are looking at the balance sheet on the 7th of the bond and they're saying, oh, they're not shrinking. Yes, of course, you have to wait for bonds to mature. That happens 15th and 30th. More complicated now. Treasury inflation protected securities. The Federal Reserve has bought a lot of these tips over the last, for QE purposes. Now, when inflation goes up, as it has happened, and gets revalued higher, one of the characteristics of these tips is that they increase in value, because they are supposed to protect you against inflation. So if inflation goes up, also these bonds actually acquire more value. And this actually inflates the Federal Reserve balance sheet because these bonds effectively become more valuable. As they become more valuable, in notional terms, they increase the Federal Reserve balance sheet visually. But in reality, over time, they will shrink back to a point that this is not true anymore. But temporally speaking, it looks like it's ballooning. But in reality, it's all an inflation effect, basically, on the Fed balance sheet. Third, mortgage-backed securities. Mortgage-backed security doesn't have a fixed maturity date, let's say. Well, it has a very long one, but generally speaking, the maturity date of a mortgage-backed security depends on the refinancing activities, prepayment activities. Now that interest rates are much higher than they were when people borrowed for all these mortgages in the US, and there were a lot of mortgage-backed security issues, and the Federal Reserve bought them. Mortgage rates back then were 2.5%, 3%. Mortgage rates now are 5 to 6%. So who in their right mind would want to refinance their mortgage, prepay it, and do another one at double the rate? Nobody would. No, and nobody's repaying and prepaying and refinancing. There are not so many maturities of these bonds coming to the Federal Reserve. So they need to wait for these maturities to come in more naturally rather than with higher prepayment. This takes more time, Tom. So it's delaying the schedule for which the Federal Reserve thought they would meet the target, but they are not meeting the target. The reality is that they even told us that if this activity slows too much, they're willing to sell mortgage-backed securities to the market actively to make sure they meet their quota. So they're not lying. It's a bunch of technical reasons, and the Federal Reserve is very committed in shrinking their balance sheet.
Mm-hmm. So, Alf, what do you think the chances are that the Fed actually gets this soft landing that they're after, and what entails that soft landing?
The chances are pretty low, if you ask me, Tom. So a soft landing is generally defined as real economic growth coming back to trend levels or slightly below trend levels, which today means in the US 1 to 1.5% positive real economic growth, and inflation actually coming back quickly to Federal Reserve targets, back to 2%. That's a definition today of soft landing. The chances are very low. And the reason is that I looked at the last 100 years of recessions in the United States and episodes where inflation was very high and how we actually brought it down. And in most cases, to bring inflation down from where we are today to 2%, we actually needed a recession. So not a soft landing, but a recession. Interestingly, it took 16 months on average, in an average recession over the last 100 years, to bring inflation down from the peak back to 2%. So a 16 months long time, and then recession continued further. So generally it takes a couple of years of pain, nothing to do with the soft landing, to achieve a drop in inflation from peak to trough, which averaged 7% as a drop. So 9% today minus a 7% average drop in peak to trough with the recession attached to it, generally would be successful to bring inflation from 9% to 2%. Now, all these episodes, Tom, have happened over the last 100 years. The system right now is much more leveraged. It's more fragile from a certain perspective, but for sure there is more total debt. Summing up the government sector and the private sector, there's more leverage now than there was over the average episode of the last 100 years when it came to recession and high inflation episodes. So right now the situation will be even more complicated because of the additional leverage and because many of these leveraged companies have survived and leveraged households have survived because of very low interest rates. They've been able to refinance their weak balance sheet because refinancing costs were very low. This has basically spurred a large creation in what we call zombie companies. It has also hit productivity levels on the economy because as long as interest rates were very low, even if your business model wasn't great, you could somehow leverage and pay, like a junk US corporate had to pay between 4 and 5% to lever up their balance sheet, which is historically very low. Right now, that rate is closer to 8 or 9% already, which makes things much more complicated. So history would suggest it's very difficult that would get a soft landing, or that with the soft landing, the Federal Reserve would be able to achieve their objective already. And on top of it, the system today is much more leveraged than it was in the past, which makes the task even more complicated.
Mm-hmm. So Alpha, as we, really dive into the nuance of the definition of a lot of these things, when we see the jobs market report come out and it's seemingly positive, once we break these job market numbers down, can that dramatically change how that number should actually be perceived? And how does that actually tie into the idea of a soft landing as well?
Yeah. So, Tom, this is another thing that I actually analyzed in the Macro Compass in one of the recent articles. What I always say is that macroeconomic indicators are of three types. There are leading indicators, coincident indicators, and lagging indicators. Now, the leading indicators are all the ones I look at, for instance, credit impulse, many other surveys out there that you can discuss, and they tend to drive or give you an idea of where economic growth is heading, or the impulse of economic growth is heading. Is it accelerating? Is it decelerating, etc.? Okay, those are looking pretty bad across the board. The second is the coincident indicators. So as the economy slows down, then it takes a while to reflect into real economic activity and decision making from economic agents. One of it would be, what do we do with labor? So are companies demanding more labor, less labor? Do they have higher inventory? Do they have lower inventory? All of that are real-time economic decisions that take a little bit of time, basically, to be seen and felt in the real economy. The labor market is one of those, Tom. And you can see right now that the labor market has been showing signs of weakness. It's not material weakness, it's initial weakness, as it's normal, because it takes time for the labor market to receive all the heat from forward-looking economic indicators. The Bureau of Labor Statistics, non-farm payroll, it's everything. It's the report that people look at first Friday of the month, non-farm payrolls. That report looks pretty good right now, especially the last one. But I discussed why that is not a complete picture. Now, in a couple of points, that would be for two reasons. The main one is the non-farm payroll Bureau of Labor Statistics outcome effectively counts multiple job holders as more jobs being created. So if Alf is running the Macro Compass and is also cooking a pizza over the weekend and he has two jobs, then there will be two jobs being created, or an additional job being created on top of the one I already had. Mm-hmm. Why is that important? Because if you look at the household survey, the household survey is not a statistical survey. It's the government calling up people at home and saying, hey, do you still have a job? How long do you work? Is it part-time? Is it full-time? And they also ask, are you a multiple job holder? So they split between part-time, full-time, and multiple job holders. And I put the table at the Macro Compass free article that shows that all the job creation in the household survey between March and today is almost all about part-time workers and multiple job holders. The amount of full-time workers has been flat or actually shrunk since March. Of course, in the non-farm payroll report, this wouldn't be evident because you see the summation of everything, part-time, full-time, multiple job holders be all accounted for, new jobs being created. So it is the quality of the job as well that matters, not only how many jobs are we creating and how are we creating them, right? So that's one. And the other one would be that according to the US labor statistics, again, it's a statistical approximation, there have been over 300,000 new net businesses being opened in the US in the month of July only. This will almost be a record high, which would be effectively the result of a statistical adjustment to account for some of the COVID distortion, because everything went ballistic in seasonal adjustments, and we opened, we closed, we opened, we closed. And so also the statistical adjustments are very significant. So the non-farm payroll is a pretty overestimated right now because of statistical reasons and nuances. It's a very overestimated labor market report. I think the household survey shows a more honest picture. And the honest picture is that the labor market is holding up okay, but it is weakening. And I expect it to weaken further. And if you hear what Amazon and Google and all the other large companies are saying, is that they are being careful with hiring, some of them. And at worst, they're outright hiring freeze or they're firing people here and there.
Mm-hmm. You mentioned the credit impulse as a leading indicator of where the economy can be going. So how how can the G5 credit impulse give us an idea of this, and where are we heading? And explain to us what that G5 credit impulse is. This is a very dramatic chart, and we'll have it up on the YouTube version of this video. So explain to us what that is.
So the G5 credit impulse measures the pace of creation of money for the private sector. So it basically measures whether our bank accounts are growing very fast, are growing very slow, or are shrinking. Wow, that's quite an important metric, because our own bank accounts are effectively composing 97% of the transactions we do today in the real economy. 97% of transactions are bank deposits or bank transfers across people, companies, etc. So if we can track whether the inflation-adjusted amount of these bank deposits is increasing, is shrinking, how fast is it increasing or shrinking, we can have a pretty good idea whether economic activity is accelerating or decelerating, Tom, right? I mean, if we all have less money, or our increase in the amount of bank deposits is slowing very dramatically, we are very likely not to spend a lot. Companies are very likely not to hire a lot, et cetera, et cetera. So if you can track the right data, you have an idea of how this is looking like. And this is the G5 credit impulse. It's the 5 largest economies in the world. Bank deposits basically held by the private sector are accumulated in these statistics, and it shows whether they are going up very fast or not at the end of the day. And you can see that in 2020, they went up very fast. And no surprise, because governments were injecting a lot of money in our bank accounts. They were cutting taxes. They were sending checks. Banks were lending us money because the government was guaranteeing their potential losses, and so on and so forth, right? So credit impulse goes up through the roof. You give it a bit of lag. So remember, it's a leading indicator. So it takes time, generally 3 to 4 quarters, to be reflected in real economic activity. And then by late 2020, beginning of 2021, the economy is booming, right? And you have earnings picking up, and you have openings, and you have spending power, et cetera, et cetera. But fast forward to the second half of 2021, Tom, where was this fiscal injection? There was no fiscal injection anymore. The latest round in the US was March 2021. Banks, they are picking up some lending as they normally do in late cycle, but it is not nearly enough to offset the fact that the government has disappeared when it comes to lending money to the private sector. The government is actually raising taxes. Look at the last tax season from the US. It was very, very good. So the government is now trying to drain some resources from the private sector because inflation is too strong, and they want to, reduce economic activity. And now the credit impulse is falling off a cliff. And one of the reasons is also that China is going through quite a deleveraging in the private sector there. And, people are getting hit, they're taking losses, and the government is trying to revamp this credit creation, but borrowers are not very happy to borrow all over again once they get these scars. It's a bit like the great financial crisis, the 2, 3, 5 years post that, or Japan when the deleveraging happened and the private sector said, I'm sorry, but I don't want to lever up anymore. So you're having this credit impulse dropping very quick as a result, which is already reflected in some of asset class performance. You can see how economic activity is slowing down on an impulse basis. You can see how earnings are projected, at least according to my model, to slow down very dramatically. You can see how asset classes are suffering, especially the most cyclical ones, especially the most risk sentiment-driven one. Crypto, the cyclical stock indices, all of these risk-driven asset classes are already getting hit because the amount of spendable money that the private sector has all of a sudden, as reflected by the credit impulse, has been dropping pretty dramatically. Now, the thing is, the credit impulse leads economic activity and asset classes with 3 to 4 quarters. And so what he's telling me is that the direction of travel is negative. Economic growth is likely to slow down further. Earnings are likely to come down further. So I need to bear that on the back of my mind. And as a macro strategist, analyst, and a portfolio manager, I need to know I cannot rely on one statistics. And I need to be very careful about what else goes on. What is the Federal Reserve doing? But I know that from an economic activity standpoint, it is not necessarily looking good.
So, Alf, despite the White House coming out and adjusting the meaning of the word recession, is this fair to take a more nuanced view of what recession should be? Or should we stick with the 2 consecutive quarters of negative GDP growth?
So a recession is defined as 2 quarters of negative GDP growth. But Tom, a recession is when people are fired. That is what a recession is. That is when people lose their jobs. Companies have to cut and not expand because they have tried to cut all the discretionary spending they could. but their business models don't work anymore. And the only thing they can do is to shrink it completely, which means they have to cut labor force as well. Then people don't have a job anymore. They can't spend anymore. They can't pay rents anymore. And then the housing market suffers too. The whole definition of a recession involves labor market weakness. Now, that's what I would say an historical recession has been. And now that's what I think the White House is trying to say is that, guys, we had two quarter GDP numbers, which were negative, but the labor market is very strong. And Alf would say very strong is a big word. I think it's just holding up okay. It's not looking very, very good, but it's holding up. And the reality is that it's the path of least resistance, Tom, from what I described so far, I think it's clear is that I expect the labor market to weaken further and to validate the path towards a recession. So we are going to have a proper recession, I believe. I cannot judge whether the magnitude is going to be much higher or a bit lower than the one we had historically, but we are going to have a recession. I don't think financial markets and asset classes are fully discounting that.
Mm-hmm. So, kind of along those same lines, we've now seen 2 consecutive CPI prints that were the same, meaning that inflation was not accelerating this month. So do you think the Fed can kind of start to claim that as a victory on inflation?
No. I mean, the thing is, the market wants to claim it as a victory in inflation because then it gives them green light to buy everything that they are used to buy, NASDAQ tech stocks, crypto, anything that makes money, right? Anything. Mm-hmm. That is what the market wants to hear, Tom. Now you asked about the Federal Reserve. And the Federal Reserve has a mandate that is inflation at 2%. It's price stability. Now, when you have inflation at 8.5 or 9, the first step to get right is that the direction of travel is the correct one. So you said it correctly, that the momentum of inflation decelerates. So that instead of having inflation month to month accelerating further, God forbid, that would bring us to over 10% inflation, and we don't want that. We have a monthly decline in inflation rate. That's good. We like that, right? For the Federal Reserve to be happy about where they're going, they need to see 2 things. They need to see that this momentum is kept over time. So they don't want to see a bump down in inflation month over month, and then tomorrow we get next month we get another higher inflation print. That wouldn't validate any trending, any disinflationary trend. And the second is, where do we land? As we discussed already in the interview, let's assume this disinflationary trend would continue because demand slows down very quick. The economy is rolling into recession. There are a lot of bottlenecks, but people get fired and they can't spend anymore. Let's assume that, right? And then recession comes down. The second question comes down where? Because if it comes down to 4% or to an annualized pace that would be 4%, the Federal Reserve wouldn't be happy with that because it is not meeting the requirement of price stability. Price stability is deemed to be around 2% because it is far away from the deflationary threat of having negative inflation. So putting it at 2% puts you on a safe band basically from deflation. But it is not 4% either, because 4% is a high level of inflation, historically speaking, that would lead people to rethink about their wage negotiation, their spending habits, their borrowing habits, and policymakers don't want that too. So the price target remains 2%, and we have to get there. The Fed hopes fast, but also the landing point matters. And the landing point must not be 4%, it has to be 2% according to the Fed.
So what do you think the goal could be for the Fed funds rate? We hear them talking about a neutral rate, but wouldn't that balance the loss of inflation? Meaning that, what do they mean when they say neutral?
What they mean is that there is this concept. I explained, I think, in the Macro Compass recently as well. There is a concept. Neutral would be a rate at which the economy runs at its potential, Tom. It doesn't overheat. It doesn't cool down. We don't go into recession because it's too restrictive. It's not ease, it's not restrictive, it's neutral. Now, of course, we cannot observe that. How do we know? What is it, 2%, 3%, 1%? Nobody knows. There are a lot of models to estimate that. They are based on demographics, productivity. They're based on the debt levels in the economy. They're based on many things, right? And of course, if the economy is very leveraged, it's very indebted, then the neutral rates will be lower because, how can you sustain all these high debt levels if you have to pay a lot of interest expenses? So the higher the unproductive leverage, the lower the neutral rate. the better the demographics. So if we have a lot of new kids coming into the labor force, they're productive, they realize economic output, the opposite would be true. So a lot of good demographics would bring higher neutral interest rates because the economy can handle it. There are so many young productive guys. We don't have young productive guys, at least in Canada or in Europe or in the US, in China, in Japan. The labor force is aging and is shrinking in many of these places. So this brings down all over again neutral interest rate. But to where? Is it 3%, 2%? Nobody knows. The estimate from the Federal Reserve is that this neutral rate in nominal terms would be roughly at 2.5%. And this means that as Powell has basically hiked rates to 2.5%, in Fed's terms, this means he's not stimulating the economy anymore. He has hiked rates to a point where it's neutral. He doesn't help the economy overeat. Hey, but it doesn't cool down either. And we needed to cool it down because inflation is at 9%. So, hey, we need to be restrictive. But the step between neutral and restrictive in the Fed head is not as simple as the step from accommodative to neutral, because, hey, I have inflation at 9%. I cannot be seen as accommodative. That's an easy win. I need to go back to neutral immediately. I need to be restrictive, right? The step between neutral and restrictive, they tend to be much more careful about it because in the past, there's always, and I have a chart on that as well, every time the Fed has tried to be restrictive for too long or too sharply, something broke. Dot-com bubble, real estate bubble broke. In 2015-16, we had China that was slowing down so fast at some point we thought the yuan would not be pegged anymore, would be a free float currency. We had the 2018 stock market sell-off, very big, and then Powell had to pivot. Every time the Fed has tried to be restrictive, something has broken. And it's easy to understand why we have such a leveraged economy and system that as long as you make the cost of money a bit more expensive for a longer period of time, something will inevitably show some cracks. So they're very careful about that. In the past, they were super careful about that, and still they generated some cracks. Right now, they can be less careful about it, I would argue, because inflation needs to be brought down. It is paramount important. So I think the risk that they will do something and put interest rates way above neutral is pretty high at the end of the day, which makes me conservative in the risks I want to take right now in my portfolio.
Mm-hmm. And Alf, exactly, as we're discussing that, what is your take on what could force the Fed to pivot from their current hawkish stance?
Force them to pivot. So from a market standpoint, in the past, it used to be credit spreads widening, companies losing access to the market, right? Or equity selling off 20, 30%. That was historically a reason for them to say, guys, we're doing too much. But now you can't say this anymore because we have an inflation problem. So from a market perspective, it needs to be something really bad. And really bad means the foundation of the system needs to break, needs to really be in trouble. So the repo market needs to be extremely in trouble for them to say, whoa, we cannot collapse the entire financial system. We have to slow down a second and we need to rescue back the market. So, but it needs to be very bad. So what I want to come across with is the hurdle from a market input that basically forces the Fed to pivot dovish. It's much higher than in the past because of inflation. So don't expect the Fed put. It doesn't, the hurdle for a Fed to have a Fed put of any sort for equities, credits, or whatever is much, much higher than in the past. When it comes to the economy, Tom, that's a different story. So if the Federal Reserve would start to see major problems in the labor market, so, the data are terrible, people get fired, the economy rolls over, and it is clear to them that this is accompanied by lower inflation as well. There is a point at which they have enough evidence that they have basically generated enough damage that they're confident inflation will slow down too. So it's a bit like they are pressing on the brakes, right, of the economy. And if they see that the car is basically stopped or almost completely stopped, they can say, okay, we've done enough damage. Maybe now we can chill out a little bit. But again, also here, the hurdle is much higher than people think. People think if, they see a couple of GDP numbers there, they will say, no, that's enough. We're fine. Guys, inflation is still at 9%. There is no central banker in the world in its right mind that can say, we're going to take the foot off the brake pedal unless they really see evidence that the damage they've done is large enough. We are nowhere there yet. So one of the reasons could be indeed if the economy weakens hard enough, Tom. But this is not a positive thing. I mean, you need to see something pretty bad, either from a market perspective or from an economic growth perspective, for them to try and pivot.
Mm-hmm. So all of this considered, Alf, how did you change your positioning in your portfolios when the Fed started this path to tightening financial conditions?
So we were in December 2021, the first time that Powell, I think, was very clear in his press conference in December. He even sneaked back then the words quantitative tightening or balance sheet reduction. And I was like, what did you just say? So he was very clear that he wanted to slow the economy down. And as I heard them, and I had my credit impulse chart in front of me and many other macro indicators, they were already looking, suggesting an economic deceleration, Tom. On top of it, the Federal Reserve told me and everybody that they were keen in slowing inflation down. So in becoming tight in the monetary policy. When that happens, you're basically having the worst possible setup for risk assets. You're having tight monetary policy when economy is slowing down. So at that moment, you have to play defense and not offense. What you do is you raise your cash allocation, which I did. So you raise your cash allocation possibly to dollars, because it will be the currency where everybody tries to hide temporarily, right? They want to have the safety of the dollar. There are so many leveraged companies that have borrowed in dollar. All of a sudden, the dollar becomes more expensive to get your hands on. Everybody runs to the dollar temporarily. We see these recurring episodes, right? So I raised dollar cash. I lowered my equity exposure to the minimum I could, especially in companies that were highly prone to repricing because they were so risk sentiment driven. They were the darlings of the 2021 tech revolution. They were the arc of this world, the Zoom, et cetera, et cetera. To all of these companies, I lowered my exposure to as little as I could, actually lowered the overall exposure to the equity market. And that was it. And back then, I remember I heard a lot of people saying, Alfie, you cannot be so underinvested because you're going to lose opportunities. But the reality, Tom, is that time I was right. And I'm also wrong, by the way, a lot of times for disclosure purposes. I don't have a crystal ball. But my analysis was suggesting that it was the time to play defense. Not always you can generate 10 or 20% returns. You need to be defensive in some cases to preserve your capital at that point. So that worked very well for the first 6 months of the year. And then around the end of June, I started buying some bonds because, I think that the Federal Reserve will have to be tight. This is quite already reflected in the front end of the bond market. It's pricing 4% Fed funds rate. It's a decent, relatively high level. But the long end of the bond market, Tom, that is a different story. That is driven by long-term growth, long-term inflation. And if the Fed does enough to break the back of inflation by lowering economic growth so much, this has to be reflected at the long end, because the damage they do now to slow inflation will remain with us for a little bit longer. So if I can start buying some bonds at 3.5%, I think they could provide a decent position in your portfolio. I bought some of them. I'm watching gold because that's another thing that once it gets temporarily hammered in the attempt that the Fed has to make dollars more expensive to get your hands on, to lower economic growth, to make things tight for everybody. Once gold has basically experienced enough of a drawdown, it could be a great asset to start buying again for the moments when the Federal Reserve will have to start easing again, make dollars less expensive, and therefore gold priced in dollar will accelerate higher again. Not the time yet. I think right now it's time again to be defensive on allocation, buy maybe some bonds for the time being, keep an eye on gold for the moment you need to jump in, but not yet.
Excellent, Alf. I appreciate that analysis on gold as well. I think that's a pretty good place to wrap up today's conversation. Is there anything else you'd like to add before we do?
Well, to thank you for the time and for this interview. Your questions are always awesome. And then maybe to just say, if people want to find more, they can just visit my free newsletter. It's called the Macro Compass. It's an article per week with some macroeconomic insights, some portfolio allocations ideas as well. And if people want to go there, I'll be happy if they have a look.
And of course, if you enjoy the sound of Alf's voice, you can hear him read most of the articles and explain it to you, as well as not just having to read through the article. And if anybody wants to follow you on Twitter, you're at Macro Alf as well. Alf, thanks so much for your time today. Really appreciate it.
Thanks, Tom. Looking forward to be back.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.